Arcwood Financial LLC, Arcwood Benefits Consulting, and Arcwood HR. As you know us collectively as Arcwood, we are independent companies of which we do not offer tax or legal advice, which is why we have our guest speakers like Dennis and Matt join us. We'd like to have them provide those details to you. But our overall goal of the town halls is really just to make sure that we can have an avenue to talk about information, help clarify it, and then also, just to provide some tools and resources for you to really help, navigate the waters for COVID and just, everything else that's going on in our lives right now.
Yes, sir. Yeah. I'm actually pulling up something really quick. So we do this probably about once a quarter as part of the town halls. We'll come on and just give you a decent high-level view of what's going on in the markets. And probably more importantly, just so you know, not why things are happening, because I feel like most of the people on the phone have a pretty good pulse of what's going on in the economy, especially our businesses coming to meetings like this, paying attention to what's going on in the legislation. But kind of so you know how we're communicating things to your participants. And today we'll start with kind of the same reminder of what's happened in the markets, but the next few minutes of it is actually from our current volatility and asset allocation presentation that we've been giving to a lot of our plan sponsors to present to their plan participants. I think there's people on the phone today who've probably done this recently for their groups, and we've had some success, specifically because a lot of 401k participants right now, they're really confused on why their 401k went up so much, then went down so much, then went back up, and also the dichotomy or the different tracks that they see with the economy versus what's going on in the market. So every once in a while, we work with different market professionals to help us with these presentations. For this one, we brought in one of the institutional investors, Paulo from Mass Mutual, and he's been helping us give these presentations. Just know we have this full participant presentation available, recorded, if you just want to distribute it to your participants, or if you want one of these, they're approximately an hour long. If you think it's a good time, we at Arcwood are focusing on social distancing, so this is it's going to have to be via Zoom, but we're happy to provide it to all of your employees. Again, a lot of you know about it and have taken us up on the opportunity, but if you haven't had this meeting yet, please shoot me an email and tell me if you would like it, or if not, just let me know you'd like the recorded option, and I'll forward that out to you as well. That's a little bit for a forward there, but Pete, let's jump into the next slide. So I've shown this slide before, and pretty much what we're looking at here is that in Q1 of 2020, we know we've had one of those volatile markets that most of us as investors, and especially those people who are participating in your company's 401ks, have ever seen. We had record losses in mid-February where the S&P 500, which is a good index barometer of what most 401ks invest in, was down over 30%. And then within a few weeks following that, the market was back up 32, 35%. Again, all-time records. So right at the beginning of the year, we saw a record bear market, and then what happened to be the shortest bear market of all times. Where does that bring us today? The S&P 500 is up approximately 5.5 year to date. So because so many of your participants and so many of us as investors have a large allocation to the S&P 500 via the indexes that our mutual fund options invest in, most participants are most likely up a little bit for the year. That's either due to the fact that they're in a target date fund. Most target date funds have a very large allocation to large cap stocks. So for example, I took the Vanguard Target Date 2045. That's one of the largest funds that represent in our plans. That's up about 2.5 for the year. And that's simply because it is an asset allocation fund. So it's not going to invest all in domestic large cap stocks. Those target date funds are going to have large allocations to international as well as mid cap and small cap. And as you go further out in duration, for those people who are closer to retirement, such as there's a typo there, but the 2035 fund, VTTHX, that's up about 3% for the year. And that's specifically because it's got a little less exposure to equities, a little bit more fixed income. I threw in there the reason why all the funds out there probably aren't performing exactly like the S&P 500. And that's again because anyone with a decent asset allocation or with a target date fund probably isn't invested all in domestic stocks. They probably have a lot of international, and that index is still down approximately 4% for the year. So that's big picture what's happened. Your participants had a lot happen to them, but they probably don't know why. Paulo, are you still with us? I'm going to let you do the next slide.
Sure.
Okay, great.
Let me just, did I say that? Okay, sorry about that. I lost the slide there. All right, so give you an update in kind of this year through July, which is a little bit of what Brandon said, but more importantly, kind of the areas of the market that have moved, which has just been tremendous. And I think one stat, Brandon mentioned about the market dropping about 34%. I think sometimes people forget the math of it. That means you need 52% to get back to even from that high, and we're pretty close to there. So think about that. You're going to have almost a 50% return in about 175 days since that market top, which is an amazing return overall. Now, what's driven this? Well, if you look at the indexes themselves, you can kind of see the differences right here. Even through July, the S&P was up 2.5% through July. Well, Dow Jones was down 6.5% at that time. Russell 2000, which is the main measure of small cap stocks, down 10%. International stocks down 10% with the EFA, which is your developed nations. Fixed income having a very good year again, a phenomenal year. Why? You've had interest rates dropping at a pretty high level. As you see there below, the 10-year Treasury at about 0.55 at the end of July. It's about 0.7 through last week. More importantly, a year ago was 2%. So just think of that. You've had a year ago, you get 2% of 10-year Treasury. Right now, you get about 0.6 or so. So that drop in interest rates has been good for bond prices. So fixed income has had a very good run. And you see there with the overall Barclays U.S. Ag Bond Index being up about 7.5% for the year, which is a tremendous return for fixed income, especially for just a little over half the year. The star of the year there, which is kind of the main story that's led all throughout, you see the NASDAQ up 20% for the year through July. And the important part of it is the tech-heavy NASDAQ has not only led the NASDAQ index, but it's these tech stocks that are also present in the S&P 500, which have led it so much. So we're going to go a little bit through that, but one thing you see below as well, as you would imagine, especially when the economy fell, and the economy did fall. You're looking at down 5% or so first quarter, over 32% in the second quarter, the greatest GDP drop we've seen. So commodities, oil really took a big hit. So that whole rebound that's happening now is on that rebound of, as somebody mentioned before, things opening up again and the economy kind of getting back. As somebody mentioned before, jobs coming back, spending, which you've seen kind of a little bit of mixed signals there. You saw a little bit of slowdown last week, and they say that was mostly because auto sales were slower, but home sales are absolutely on fire this year, and you're seeing a lot more spending coming back over the last month or so. So if we can go to next slide, show you a little bit kind of some of the things that, you know, one of those people always talk about Main Street versus Wall Street. And in terms of Main Street, you saw that huge drop. Retail and food sales. Unemployment, by the way, got up to about 15%. Been clawing its way back. We're up about a little bit, 10.5% as of last call on a national basis. I know it's different per state, but on a national basis. So the low there was at about 15% on the unemployment rate. The S&P, you saw that drop. The low, by the way, March 23rd. And we keep that in mind because there is a reason why it kind of turned and why we've been good heading up ever since. And also coinciding with the low that we had there in oil. And oil, as you remember, got all the attention there for a while when we actually had negative oil there for a couple of days as people were worried about getting stuck holding oil, and we're actually paying people not to have to store that oil. At one point, I think we had negative $30 a barrel. You know, weird thing involving options markets, but still, it was funny to see people literally paying people not to have to store oil, which was seen as being kind of useless and worthless at that point because the economy was contracted by so much. Next. So what's moved the market and what, you know, where do we stand today? 2020, above all else, has been just a continuation of the trends for the last 3 and 5 years and really for the last 10 years. main trends: large cap stocks, the big companies outperforming small cap stocks. Domestic, the US outperforming internationally, and then growth outperforming value. Those three trends have kind of continued on now, really off the market bottom. The market bottom was March 9th of 2009. Off that bottom, those have been the three trends that have continued. So large cap, domestic, and growth oriented. Now, this year has taken it to a whole different level in terms of the gap in performance among those areas. So to give you an example, you take the Russell 1000 growth, that is the main index that we look at when we're looking at blue chip growth stocks. That index through last night is up 21%. Large cap value, think of banks, energy stocks, industrials, big blue chip industrial stocks, through last night, down 10%. So think of that gap, up 21 versus down 10, and that's among all large cap stocks. So tremendous gap there. Why is that so? Well, for one, some of these stocks have held up much better because the growth has been there in these names. So the names that you hear about all the time, Facebook, the so-called FANG stocks, and it's FANG with 2 A's, so it's Facebook, Apple, Amazon, Netflix, and Google. And you can add Microsoft into that mix, have just had a tremendous run because they've continued to deliver tremendous earnings. And more importantly, there is a notion that they, if anything, are picking up more market share and are going to have better earnings going forward. Now, has it gotten to a point of too much of a good thing, if you will? That's a discussion that we have all the time with all the different money managers that we deal with at Mass Mutual. The value guys will tell you, this is crazy. This reminds us of '99 when everybody was just buying internet stocks and nothing else. The growth guys will tell you, well, that's just those guys whining again because nobody wants their stocks they have because our companies are the ones that are delivering all that growth. And when growth overall slows down, companies that are growing get bid up. And that's really what you've had so far this year. The big have gotten bigger. And this is spread out even beyond, say, the FANG stocks. UPS just recently hit an all-time high because they just tacked on a surcharge. So all the people that do deliveries for the fall season, they can't hire. I mean, for the holiday season, they cannot hire people fast enough. Domino's Pizza is a great example. They just said they're going to hire 20,000 people. They can't hire people fast enough. And if this stay-at-home stock trend continues, companies like Domino's, like Amazon, like Zoom. We happen to be on a Zoom meeting. I think Zoom is up 300-400% this year. So tremendous run by certain names. The important part you want to know is the level of concentration has really been taken to a different level. So if you look at those big names, the S&P 500 that we all follow and most of the market is 500 large cap stocks. If you take those 500 large cap stocks, the top 40 make up as much as the bottom 360. And even more concentration, the top 10 stocks matter as much as the bottom 200 stocks. So there's a tremendous amount of concentration at the top. It is a market cap weighted index. So the bigger you are, the more you make up. So I'll give you one example. I think Apple it's knocking on $2 trillion in market cap. Apple and Microsoft alone are bigger than 264 companies in the S&P 500. Those two companies combined would be bigger than the bottom 264 companies. So a tremendous amount of concentration. Not trying to make a prediction of where this goes or doesn't go, but you want to know kind of how that's moved, because if you dealing with people that have questions on it, if they have more growth-oriented funds, quite honestly, they've done better this year. If they have more value-oriented funds and they're wondering how is the market hitting record highs and I'm down money, because quite honestly, whether you have large cap value, mid cap value, or small cap value, you are negative for the year. International is still negative for the year. So that's been the drag on performance so far here in 2020 so far.
Yeah, that's a good point. And just so everyone knows who's a sponsor or an investment committee member on the phone, we are framing this so people actually understand where their returns are coming from, because there's so few stocks that are actually pulling the market higher when the 30% of the S&P 500, which almost all of our investors are invested in, is up 30%, while the remaining 450 some odd stocks in the S&P 500 are down for the year. But also we always point out that they are invested in these, and we're not recommending they go have a higher allocation to Apple, Facebook, Amazon, Berkshire, because all of them probably have a good 2 to 3 to 4% of these already. And we're also pointing out, to Paulo's point, that even though it was an opportunity in the last few years, and especially the reason their portfolio is up for this year, it can present a risk in the future because of the concentration. To your point about growth versus value, most of your participants that are in an asset allocation model or defaulted into a target date fund will have an equal blend of growth and value. So even though value has been underperforming for the last decade, they have a representation of both. So they kind of level each other out. Those participants that are out there selecting their own funds and could be allocating the value versus growth, yes, that is an issue, and that's definitely part of the reason why we want to be in front of them as much as we can, just so we're making sure they're doing a correct asset allocation. Sorry, Paulo, go ahead. Next slide.
No,
please.
that's all right. I think it's a great point because it's the main thing that we get all the time in terms of this gap. And those who've been in the business a while, as I have, I certainly reminds me of 99. The thing though is, and this is why we're not trying to make any predictions. Well, people were saying that around early 98, and there was another 40% the market went up in tech stock before stuff fell in the first quarter of 2000. So the reality is, like I said, these companies by far are the market leaders. And there's this notion, before we get in kind of monetary and the stimulus that's happened, there is a notion of investor sentiment and are people getting too excited? We really don't see that in the 401k level in terms of all of our, we have millions of participants that we do as a record keeper and looking at moves. There hasn't been very drastic moves as far as people all going to chasing growth or things of that sort. Where you do see some of this excitement, probably too much, to quote Greenspan, the irrational exuberance, if you will, is in some of these high-flying names where you see more of the I hate to call them mom and pop investor, but these people that are staying home, and that's the Teslas of the world, or more importantly, as we always say, the next Teslas of the world. It seems like there's about 20 electric vehicle makers now, and each one of them is moving up at pretty rapid pace. That's where you're seeing a lot of this speculation, but that's not really at the major companies. That's more of some of these other speculative stuff. Now, here importantly,
Tesla did pretty good today.
Yeah,
Sorry,
Tesla. I think this is a sign where some managers will tell you maybe it's getting a little over the top. Tesla announced they were going to split the stock 3 days ago. It's up about $350 since then. I mean, just think about that. And then you all know a stock split will do nothing for you have the same exact thing. Instead of having one share at $10, you have two shares at $5. So there is no value increased by that. But just that notion that they're going to split, and this will allow more of the smaller investors to now invest it at a cheaper price. The home gamers, as Jim Cramer always calls them on CNBC, that stock is up $350 on that announcement. And by the way, Apple announced theirs about a week and a half ago and has had a nice run as well when they announced the stock split. So do not be surprised if you see Amazon splitting, some of these other ones coming down the road, because they have gotten to prices that the average person at $2,000 a share, or in Amazon's case, closing on $3,000 a share, probably can't buy it. The thought is if you split, maybe you could buy it at $300-400. So anyway, in terms of what led a lot of this return, and as I talked to you, the bottom was on March 23rd. Literally the world changed on March 23rd. It changed for fixed income when the Fed came in and said, we are going to back these bonds of these companies that are having issues, specifically these high yield bonds that were really, really struggling. So when they did that, and there's an old adage, and I worked for many years with Zweig funds, somebody might have heard of Marty Zweig, and one of his number one sayings above everything else, don't fight the Fed. They've got more money than you do. So when you have the Fed come in with that much buying power, that said we're going to back these things, you had a complete shift and complete turnaround in the fixed income market. And you had that on top of that, this move towards where we are, zero rates. And as our money managers like to say, who doesn't like free money, right? So as you're lending out a lot of money and companies are certain taking it, I saw a piece that as this morning, as of this week, companies will have issued more debt than they did all of 2009 combined. So they're certainly taking advantage of these very low rates and borrowing money as much as they can, because the hurdle rate, if you will, is so low for them to get over. So you've had tremendous amount of stimulus from the Fed. As you guys heard about the CARES Act, and certainly the notion or the belief, talking to all of our money managers, that there is another CARES Act to come. It's just a matter of what it's going to look like. But there is another one to come. And I think as somebody pointed before, it is amazing we've gotten to that. $1 trillion will be the disappointing or small one, but there is more stimulus to come, everyone believes. And then on top of that, you have very low rates. And as the Fed said in their last meeting, very low rates for quite some time. We are not of the belief we're seeing negative rates. However, as you on the phone probably know, there are negative rates in many parts of the world, and it's certainly something that makes our fixed income look attractive to foreign investors. Because when would you buy a 30-year bond at 1.2%? You would when the 30-year bond in your country is currently negative. So just think of that. And there's places like Germany and Japan where you lend them money and they pay you less 30 years later. So that's the impact of negative rates. So overall, like I said, on the monetary side, huge inflow from the Fed in terms of backing these bonds, which has had by the way, to the point of unprecedented. Not only they're buying back in the market, they're buying bond ETFs, and as of 3 weeks ago, buying individual bonds as well. So stuff that we haven't seen from the Fed ever. So a tremendous amount of monetary supply. Also low interest rates makes an environment where people are searching for somewhere to park the money, and equities have been the recipient of that money.
Great, awesome. Well, thank you, Paulo. I appreciate that. Hopefully, all of you get an idea of what we're trying to communicate to participants. Just the 3 main factors that are driving the stock market right now, so they know. The rest of that presentation we offer, again, is on the main concepts we always try to do: diversification, asset allocation, history of bear markets, etc. Just reach out to us if you want Paulo and I to do a presentation for your group, or if you want the recording. Again, thanks for having us today. I know we took a little bit of time. Pete, I'll give it back to you.
Thanks, guys. I appreciate that, because that was a lot of questions that were coming in our doors. You know, one, why is my portfolio down when I see other people's are talking about their portfolios up? And then also, why is our stock market going through the roof and hitting records when we have 30 million people that are out of work? So I think it was a good time to revisit that.